So anyone coming in late, again, if you could, get your name on a 10 card, that'd be terrific. Welcome to week 2 of partnership tax. Hopefully by now, everyone has the textbook. Everyone undoubtedly has the code, and everyone recognizes that partnership tax is a jealous mistress, right? You got to put a lot of time, effort, and energy in. It's a tough course. There's a lot of material. And it's not for the faint of heart. All right? Logistically, everyone's okay. Could find parking hopefully tonight. Found the classroom. Several people, because of work commitments, couldn't make it tonight. We're going to try, emphasis on the word try, regularly to offer it vis-a-vis WebEx. So if you get stuck at work, there's 2 people who got scared of partnership tax.
I might have scared them. Well, at least one of them.
All right. So let's just review, guys, as usual. Let me just summarize what we covered last class and highlight those things that I think are important. And we'll get right into the new material. So let's just, for those of you who just got the book, some of you are just getting the book, so let me summarize. We have the general introduction in chapter 1, and the introduction talks what is the difference between a partnership versus a corporation, proprietorship, how do you conduct business, and the distinction between the entity versus aggregate approach. The entity approach treats the partnership as a standalone entity. The aggregate approach looks through the partnership and treats it as a complete pass-through entity. So throughout the entirety of this book, there's this dichotomous approach. Should a partnership be treated as an entity? Should it be treated as an aggregate? And we're going to have to decide, or the code decides for us. We don't have to decide anything. The choice is made for us. Just for those people on WebEx, be forewarned, it'd be best if you put yourself on mute, okay? Just, we can hear everything you say. All right, so then we talk about, the authors are going to introduce us, just like in corporate tax, to what is the appropriate business entity. And I said in yesteryear, it was a no-brainer. For 20 years, I think practitioners would say universally that unless you thought, or your client thought, that it was going to go public anytime soon, the best choice of entity was an LLC, right? But now, with the corporate tax rate under Code Section 11, a flat 21%, utilizing a partnership may, emphasis on the word, may not be as attractive. I still subscribe, and I think most of your clients will subscribe to the notion that if I were you, I would still recommend a limited liability company. Why? Because if corporate tax rates go up, most of you who've had corporate tax, and this class will not test you on corporate tax, but just recognize that getting out of a corporation is not inexpensive. There's usually a tax toll charge. So if it were possible, for business formation purposes, when in doubt, I would form a limited liability company, all right? And I'm not just saying that to try to get your attention because you're in partnership tax. I truly think that it makes a lot of sense. So you look through this, and chapter 1 is going to make a lot more sense as we go through the material. We talk about different tax rates and all the different issues. But again, once you have a better handle on the entirety of partnership tax, this will make far more sense. Once they talk about choice of entity issues, they talk about identifying what is a corporation versus what is a partnership. And as opposed to yesteryear, this is very easy. Why? Because essentially the IRS has said you can be whatever you want to be. You want to be a corporation, incorporate. You want to be a partnership, form a partnership. If you want your partnership to be taxed as a corporation, that's okay. Elect for your partnership to be taxed as a corporation. So the choice is yours. This is spelled out. In yesteryear, there was a lot of controversy. If you set up a limited partnership or a limited liability company, would the IRS challenge you and say, well, that had more corporate attributes, and therefore you should be taxed as a corporation? All that went by the wayside, guys. That is no longer debatable. All right, we have this now check in the box regulations, and essentially the court, or I should say the IRS, has said, we're not going to get involved in here. Whatever you want in terms of an entity, you can be. All right? Not all times when taxpayers come together as a partnership. Sometimes there's simply a fee-sharing arrangement or a tenancy in common. The authors of our textbook give us one or two examples of when something may or may not be a partnership. And brought that to our attention. I said, don't worry about publicly traded partnerships, and don't worry about trusts. No one forms a trust to conduct business. All right, so chapter 1 is pretty straightforward. I will say, chapter 1 does emphasize a question that does come up regularly in your practice. What kind of entity, many of your clients will say, what kind of entity should I form to conduct business? And you have to explain from several different vantage points why a partnership is more flexible than an S corporation, doesn't have a double tax, easy to get into, easy to get out of. No other business entity offers this much flexibility. All right? Does anyone have a question about choice of business entities? It is not crisp clear, but I say on balance, the answer is still a limited liability company, LLC. Any questions, issues, concerns? Chapter 1. We're good on chapter 1, guys? All right, chapter 2. We talked about formation of a partnership. And we said that forming a partnership, generally, Congress rolls out the red carpet, right? Just like Congress did with respect to corporations. Generally, not always, but generally forming a corporation is tax-free. And we know this under what code section? Code section 351. When it comes to partnerships, Congress too has the welcome sign, right? It wants taxpayers, where possible, to engage in business. So when you form a partnership, there's a different code section that says not taxable. That code section is 721, which is the analog to code section 351. So if you have a bunch of people, right, all it takes is 2 to have a partnership. You might think that's a smiley face. No, not smiling. What kind of emoji would that be? If you, what word would type where you just get the flat line with 2 eyes and a flat line? I forget the emoji that pops up. What is it? Well, I'm just talking, there's, I don't know,
Yeah.
it just comes out like that, or that's supposed to be a flat line. All right, but in my world, this is a partnership. I don't know, all right? And we have different code sections at play, right? So, you form a partnership, tax-free. Everyone agree? Hopefully. Unlike corporations, which require 80% control under code section 368C, partnerships have none of that, okay? There's no control issue. So 721 is even a brighter red carpet treatment than 351. So as you know, partners contribute property down to the partnership, and what is the partner's tax basis? Remember, we have outside and inside basis. Everyone, you're getting used to a little bit of the jargon, right? Inside basis is the partnership's basis in the assets it owns. Outside tax basis is the basis that you have in that piece of paper known as your membership interest or your partnership interest, right? Everyone got that? Because when you start talking to your clients or your colleagues, you got to walk the walk and talk the talk, and you got to know inside versus outside tax bases. Agreed? All right. So if you contribute property to a partnership, what is your outside basis and what is your authority for saying that? So, Mila, what is your outside basis and what is your authority for saying it?
Outside basis is an adjusted basis.
Okay, and what's your authority for saying that? Kevin's can't. I admire Kevin's enthusiasm and whatnot. He can't say no. So Kevin, what was it?
722.
Code section 722, right? Code section 722. And what is your holding period, Viva, in this piece of paper? Tapped. Always?
No. For the partnership.
No, but in your case, the partner owns a piece of paper.
No, not always.
When is it tacked and when is it not tacked?
1231 and capital gain.
Capital assets.
Capital assets.
1231 and capital assets, your holding period will be tacked. What's your authority for that? 1221 talks about what is a capital asset. 1223. Okay. Code section 1223.1. Right? 1223.1. Okay. Right? And by the way, again, if anyone, I can't, too many people here, but if you don't have, you can come up. I need you guys to, your 10 cards. So if you come up, just sneak on by me. All right. Then what is the partnership's basis? The inside basis, right? What is the inside basis? 723. And it's Alan, how do I pronounce your name, sir? Alan is in, the I is silent. Did I say that right?
It's Alan.
Say it again, I'm sorry. Alan. Okay, Alan. What's basis is the, what's the inside basis? Of the partnership assets? We know the authority, 723, but what does code section 723 say? Right, and what's the tax basis, the inside basis of the assets contributed? Well, it may not be, right, Chrissy? Carryover basis is the word I'm looking for. It's carryover basis, right? It's going to preserve the gain. It's carryover basis. Is the holding period taxed, Simi? Just say it loudly. A lot of people here. Does it matter, Isabel? Yes? No? What is it? What's your authority?
I'm not sure.
Okay. Go ahead, Sandy. Okay, it's carryover, and in this case, it's 1223.2. Okay, all property contributed as a tax holding period. Okay,
That's when it comes to the partnership itself, right?
that's the inside basis,
Okay.
right? Now, right, so the authors give us a revenue ruling that talk about the dynamics of the connection between inside and outside tax basis. Talk about, I said, don't worry too much about non-compensatory options, debt for equity exchanges. We talked a little bit about promissory note, and I talked about the importance of the problem on page 40. Now, I don't know if people had a chance to review the questions on page 40. Right? But this is a generic problem that you could probably see or will see something very similar to this for exam purposes. So just make sure everyone can handle, and if you can't by in the next few weeks, ask me, because when people form partnerships, you gotta be able to explain the consequences such as those on page 40, right? Because people like yourselves or your clients will come together and they will contribute different pieces of property. And you have to, people want to know, what is the inside basis, what is the outside basis, what are the tax implications, right? So I'm saying this in a beloved fashion, anticipate for exam purposes, both the midterm and the final. The final is cumulative. It's not just on the second half. It's cumulative. That you can anticipate a partner formation question, right? And that everyone here will not say, oh my God, I can't believe he asked that question. All right? I want you to respond like, I'm bored with this exam. He's asking about a formation, and this is the 100th time I've done it. Okay, so that would be a good sign if you're bored on the exams, okay, guys? I'm going to try to tell you everything that I think is important and that you should be prepared for. Again, any questions? Everyone can handle formation, and again, if you're embarrassed to raise your hand, okay, I get it, shoot me an email, but practice, all right? Go through this, make sure it makes sense to you. Alan?
So you understand where the code 722 is for the outside property type.
Outside basis.
Outside basis. And the 722 is the inside basis.
Perfect. Okay? And if I'm giving you a hard time, it's not well, it is purposeful. But it's just, you got to get the language and be precise for both your clients and for, people, in this world, there's an expectation that you know the exact lingo. Okay, we're going to talk in chapter 4 a lot about special allocations. What special allocations are allocations where even if I'm partners with George and we're 50-50 partners, we decide for whatever reason Solid's going to get 70% of the profits this year. George is going to take 30%. That's a special allocation. Should that be respected? And what's going to be pivotal is that you maintain capital accounts, right? You maintain capital accounts. So we are introduced in this chapter to capital account maintenance. And we're given general precepts here. And we're going to get more in chapter 4. So just be forewarned, you're going to see a lot more of this. How to maintain capital accounts. And you should walk through, it's not complicated. The authors are very good. That's why this got to be a 9th edition. Just like I say in income tax, this partnership tax book, #1 graduate tax book in the country. It didn't get that way just because it has I'm not going to say a pretty blue cover, but it has a pleasing to the eye blue cover, okay? Because the problems are pretty straightforward and somewhat easy to follow. Right, capital account, just to repeat what I said on Wednesday, represents your economic stake in the enterprise. Okay, represents your economic stake in the enterprise. And George, if the partnership takes out a liability to make an acquisition, will that change the capital accounts? And then Ramon, see if you agree. George, yes, no? Won't? Ramon, agree or disagree? Is that a no or I don't know?
No, it's not going to change.
Agree. Okay, everyone agree. No change. Everyone agree? No change. So a debt does not change the capital accounts. All right? So that's pivotal because I've seen people, does it change your outside basis? Yes, right? Jacqueline, what's the authority for that? Outside basis. What code section? $752. $752. All right, we're going to see code section 752. All right, and we're going to learn more of that beginning on page 48. The authors begin a discussion of liabilities. And you might say, why are they beginning a discussion of liabilities? Isn't that getting ahead of themselves? Because in chapters 3 and 4, there's going to be an elongated discussion. Why in chapter 2? Are they just looking to make your life painful? You may think so. But no. The reason they're introducing liabilities in chapter 2 is because when people contribute property, they contribute property subject to liabilities, right? So, general rules, we're going to get into more detail. If you contribute property subject to a recourse liability, First of all, Gus, what's the difference between recourse and non-recourse?
Okay, we'll go back to the pointer.
Or let me just get Gus on this one. Gus? You're not sure for this one? So, Antic?
I mean, recourse is, if it comes back to either non-recourse is provided by all the partners equally.
But what's the difference what is one would mean versus the other? How do you know you have a recourse liability versus non-recourse? Okay, because that's going to be a pivotal question. Michael?
Recourse is non-recourse one, and non-recourse.
Right, non-recourse, it can't come at you personally, right? When I say whoever the lender is, right? Michael, let's fill in that pronoun. The word they is the lender. If the lender can go after your personal assets, that's called recourse liability. If the lender can't come after you personally, right, that's non-recourse liability. So, in terms of liabilities, if there is a liability, if it's recourse, Giandelli, did I say that correctly?
Yeah.
Okay. What happens if it's recourse? How is that liability going to be treated for tax purposes, partnership tax purposes? Sure. Danielle? Just say it loudly. Big class.
The loss is here.
That's loud?
The loss is here to the person.
Well, that's true, but for tax purposes, how is that going to be treated? That's yours, Sonali? Anna? Recourse liability?
Recourse is based on how the losses are shared and it's increasing your tax basis.
Okay, everyone got that? Recourse liability depends on who bears the onus of who bears the onus of the loss, right? That's recourse liability. And Julia, when it comes to non-recourse liability? Not sure? Ken? If it's non-recourse, how is it treated for 752 purposes? You're not sure? Nick?
Is it pro rata?
Is it pro rata? Sandra, you had your hand up or semi up?
It's allocated by.
Just say it loudly.
It's allocated by the respective share.
Well, profits. In other words, recourse generally by losses, non-recourse by profits. Okay, it gets more complicated than that. I'm oversimplifying, but for our purposes, at least that's a starting point, okay?
Repeat that again, please.
Recourse is expressed as who bears the losses. That's how the liability is going to be divided for Alan. You'll appreciate this, outside basis purposes. And non-recourse is based on how profits are allocated.
Partner, their recourse as well. Does
Right.
they have a higher inside,
Don't say
or
inside.
outside basis in the partnership?
Yeah, you have a higher out, and that makes sense because under Crane, right? If a taxpayer has a liability, buys a building, puts down 10,000, borrows 90,000, what's their basis in the property? 100,000, right? And the partnership rules in 752 are designed to replicate what would happen if you did it on an individual level, right? Anything you were going to say? You're good?
Yeah.
But I just want to give you context. Because again, you may be saying, you know, did these authors have a little bit too much to drink? Because why are they bringing up 752? We're just trying to do with partnership formations. They're doing it because the contributed property may be subject to liabilities. All right, so I'm just, no, maybe they did have too much to drink. I can't answer that question, but I can tell you why they're doing it here as well. All right, so they're going to give us a general discussion beginning on page 51 about contributions of encumbered property, whether it be recourse or non-recourse, okay? And some of this will depend on whether or not the liabilities are in excess of tax basis, right? Whether the liabilities are in excess of tax basis, okay? Because you guys may, for those who've had income tax already, recall under the Tufts decision, remember Tufts? Where if a taxpayer allows property to be foreclosed, where let's suppose the liability in my example is 100,000 and the taxpayer's basis is 50,000 in the property, and the taxpayer says to the bank, you know what, you just take the property, I don't want it anymore, and they get no cash, zero cash. Is that a recognition event? And if you recall under Tufts, the amount realized would be deemed $100,000, right? And the basis is 70, they would still have to recognize a $30,000 gain. So when taxpayers form a partnership and they shed liability to their fellow partners, okay, where the other partners are going to assume a pro rata amount, that may give rise to a so-called Tufts-like gain, okay? Well, we're going to talk more about this, but again, this is just preliminary. We went through the problems. We ended up on page 56. All right? Now, there's a lot of information contained in chapter 2, guys. A lot of information. For exam purposes, we're going to try to just keep it to the most important things, but you really have to spend the time on this. Again, as I forewarned you, this is nothing that you can just put the book under your pillow and hope that somehow, miraculously, the information is going to be transferred to you in your sleep, all right? So, any questions on any of the material we've covered? Any questions? All right. So that's my summary of material covered to date. So we're going to finish up this chapter, not too hard. We only have 2 or 3 more pages. And then we're going to go full throttle into chapter 3. I'm not sure if we're going to finish chapter 3 tonight, but I aim to take no prisoners. All right? I'm very ambitious, and you should be a bit worried. Why? Because as opposed to, I'll call it my mellow coffee, I got cold brew, which is going to make me bounce off the walls even more. So, we'll see if we can keep this at a high pace. There's a new coffee. If anyone loves coffee, there's a new coffee place in Newark, 2 blocks from here. So, if you're having a tough time on a Wednesday afternoon before class, I will give everyone directions where you too can get some good cold brew coffee. All right, organization and syndication. I should pause for 1 second. Now that we've summarized this, weekend events. Did anyone do anything interesting over Labor Day aside from Master Chapter 2 and 3? Aside from that, nothing. No one did anything. I will start by saying I did survive. I'm here today. I did do my 62-mile bike ride, and I miraculously, if you guys, I'm assuming everyone was breathing on Saturday, it was one of the most spectacular days of the year, right? Low humidity, 70. So someone upstairs, I think, was looking after me because I needed everything I could get. But it all worked out well. I did, it was in Newport, Rhode Island. How many people have been there? So it's a very pretty place in the world, right? Some of the mansions a little bit, or I should say a lot, over the top. But it was what it was. So anyone else do anything interesting? I think, Mike, you're a bike rider, right? Mike is a triple Ironman? You have an Ironman coming up. So just for the class, what does that translate into? 112 miles. So what I did was nothing. It's just training wheels practically. And what else? I mean, that's just one part of it. How much do you run? All in one day? All right, so that's a real man. I'm just, playing games up here. And Dee's not going to tell you, but I found out through the grapevine. She did promise her husband she'd be silent for 1 day.
No, 3 days.
3 days?
Yeah.
I asked her in message that can you share me the link? So she said
Yeah.
I cannot.
I
do
shouldn't
it.
have, Vibha had texted me and I shouldn't have responded, but I still responded to her because it was her.
After that.
All right, and her husband missed her, or at least that was
Yeah,
what
he
I was
did.
told, okay? So, that was her event. Anyone else have any events? All right, well, if you think of anything as a class, we want to hear it. All right, so let's talk about page 56, organization and syndication expenses. Many of you, not all of you, but that's okay. You'll hear this again in other classes, and that's what's great about tax. You get reinforcement. In income tax, we talked about startup expenses, and startup expenses under Code Section 195, you have to generally amortize them over what period of time?
15.
15 years, right? Generally have to amortize them over 15 years. What's my authority? Code Section 195. If your organizational expenses are $50,000 or less, you can expense the first $5,000, right? And for some of you who've had corporate tax, Code Section 248. Surprise, surprise, if you form a corporation and have startup expenses. What's the deductibility? What do you think, Tom? Same, right? There's a shocker. The code's going to be really consistent, right? 15 years, but if the startup expenses are less than $50,000, you can expense the first 5. For every dollar above $50,000, you lose $1 of immediate expense. So if your organizational expenses are $54,000, you can only expense the first $1,000, and then the other $53,000 you have to amortize over 15 years. Partnerships. Tom, you're on a roll. What's the roll and where is it? So say it loudly, guys. We're a big class. Same. What's your authority? 709. Okay? Code Section 709. Right? By the way, if anyone on WebEx, if you guys see I'm not really looking, if something's flashing so someone has an issue, just let me know so I can try to be alert to people on WebEx. All right. So my point is there is consistency. 195, 248, 709. All these rules are the same with respect to organizational expenses, and they're distinguishable from so-called syndication expenses. Syndication expenses, you have to just capitalize, and they're deemed not to have a useful life. And the authors make this clear. They talk about organizational expenses on page 56, and on page 57, they talk about syndication expenses, right? So let's look at page 57, and these are problems similar to those in the corporate tax area. We have Napa Hotel Associates is a limited partnership that was organized in December of the current year to construct and operate a luxury hotel. Developer will serve as a GP, contribute $100 cash. There's interest, limited partnerships, interest of $100,000 have been sold by the broker to 20 investors, each of whom has been furnished with a voluminous prospectus describing the offering. All the investors are clients of financial planner, an affiliate of broker, who acts as an investment advisor to wealthy individuals. To what extent are the following expenses, all of which are paid in the current year, out of the $2 million contributed by the limited partners, properly classified as organizational expenses under 709B3? Okay, let's categorize these. So, let's go through. We have a $100,000 placement fee paid by broker for his efforts in selling the limited partnership interest. So in this case, Ben, EK, what do you guys say? Ben? No, EK? You gotta say it loudly, EK. Why not? What would you call it? David, what would you call it? Yeah, it would probably be a syndication expense, right? A non-deductible syndication expense. The regulations under 709-2B. Code saying regulation 709-2B. How about a $50,000 organizational fee paid to developer for his services in connection with the organization of the partnership, negotiating the terms of the partnership agreement? Charmaine, what do you think? Deductible or not? Deductible, why? Just say it loudly. What? Okay, it's just a regular organizational expense, right? So should be, when I say deductible, it's amortizable over 15 years, okay? Except for the first $5,000, then it just depends on how much the overall expenses are. I mean, the $50,000, $5,000 may be, it depends on what the overall startup expenses are. All right, but it's not a syndication. How about $40,000 paid for attorney for drafting the partnership agreement, filing the necessary papers, and preparing the offering documents? Corey?
Yep.
Let me just ask Corey.
Sorry.
And Hafid, see if you agree. All right, let me see, Corey. I just meant I want to get her answer and then see Hafid if you agree with her answer. Just everyone's got to talk really loudly here because John's not back here. Mike, can you hear that? So you would say, and you would say it loudly. Not deductible? Hafid, would you agree? All of it would not be deductible. What would you typically do with attorney's fees? Attorney's fees, you would look at the hourly bill to each, because drafting the partnership agreement is an organizational expense, right? But the filing necessary papers and preparing the offering documents or syndication expense. So it could go either way. There's some of this is going to be deductible or amortizable over 15 years. Some of it, right, is going to be a non-deductible syndication fee. How about $10,000 to pay to accountant for preparing financial projections included in the offering documents? Would this be deductible or not, Francis? Just say it loudly. Why? Yeah, but isn't this part of the offering documents? And offering documents have an aroma relating to syndication expenses, right? So this would probably be a syndication expense, right? Because this is how you get people to sign up. So this is probably more in line with the syndication expense. How about $10,000 paid to printer for printing the limited partnership offering prospectus? I think you guys can all answer this. It's going to be a syndication expense, right? How about $20,000 paid to tax accountant for tax advice for prospective investors, preparation of a tax opinion letter concerning the issues affecting the partnership? Say again? Who said it? I just, Jacqueline, you say syndication, right? Yeah, this is probably in line with the syndication expense, right? There's actually a revenue ruling 88-4 that would suggest these kind of expenses are syndication expenses. G, $40,000 to an initial fee for the financial planner for services to be rendered by her reviewing partnership tax returns, assisting in the preparation of financial information to be furnished to the limited partners, and for acting as a liaison between the general and limited partners. What was that, George? Or someone else said? Okay. Deductible or not, guys? Ramon, you said it? This looks like an ongoing expense, right? So it looks like a code section 162, right? Expense that's going to happen all the time. So I think this should be deductible unless there's any of these expenses that pertain to the offering documents. Because if they pertain to the offering documents, they're going to be considered syndication fees, right? So generally it should be code section 162. It looks that way. We might want to ask more questions. Any questions? Chapter 2, just remind ourselves. This is, if you look back at chapter 2 before we get into chapter 3, guys, this is all about formations, and I may mention it in last class, but again, there's only so much your brain can absorb. One thing is clear, but you may not understand this yet. It's that code section 721 transaction, notwithstanding it commences a partnership, it can happen any time during the life cycle of a partnership. Everyone agree? It's not necessarily a one-shot deal. That there can be a 721 event today when the partnership's formed. Next week, next month, there could be 20 different 721 events for one partnership. Just like code section 351 does not mean that it's necessarily the start of the corporation and that's it. There can be multiple 351, right, events. Just bear that in mind. It's not a one. Some people think, oh, we're not dealing with a formation issue anymore. We're not dealing with chapter 2. It can't be a 721. That is not true. All right? So everyone's got it in their brains now. 721 can happen anytime. Very exciting. Okay? 721 event, anytime. You guys ready to talk about chapter 3? All right. All right. Operations of a partnership. General rules. The authors are going to introduce us to several different code sections. Might as well just open the code. There's 3 the authors introduce us to just quickly. We'll just take a quick look at these. So, code section 701. By the way, very exciting when you look at code section 701. What's on top of code section 701? There it is in big letters, subchapter K, right? And just in case you were wondering what subchapter of the code we were in, there you go. So code section 701 reminds us that it's the partners, not the partnership, which is subject to tax. 702 talks about that you have to take some items into account separately so that the individual partners can decide their income more readily. And 702B, that the character of the income is going to be the same as in the hands of the partnership. Code section 703. Partnership computations. Says that some of the items are going to be separately stated. Those are already under 702A. And that certain deductions aren't allowed to the partnership, but they end up being allowed to the individual partners. Say it loudly a minute. Section 179, which is bonus depreciation. What kind of tax return does a partnership file? Form 1065, right? Everyone knows that? When is it due, Minna?
Third month, March 15th.
The 15th day of the 3rd month, right? March, for calendar year taxpayer, March 15th, right? All right, and again, under 702B, it's the partnership that determines the character. So, we have a revenue ruling 68-79, old revenue ruling, right? Half a century old. And here, we have a partner, joins a partnership, partner D, several weeks ago, just to make it up, right? Doesn't matter. But the partnership held a capital asset at the time, the holding period to get capital gain treatment. Recall that capital gain treatment is found under Code Section 1222. Code Section 1222 defines what is long-term. What is currently, how do you secure long-term capital gain treatment? What is the requisite holding period, guys? More than 1 year, right? If it's more than 1 year and you're an individual, you get put into Code Section 1H, right? What was it? Over the years, it's varied, right? And during the time period this revenue ruling was promulgated, what was the holding period requirement?
6 months.
6 months, right? 6 months, more than 6 months, right? I should say.
6 months and a day.
6 months and a day, right? And now it's more than 1 year, but at the time it was more than 6 months. So even though the partner recently joined this partnership, the partnership itself held an asset for more than 6 months, sold it, and partner D was able to command long-term capital gain on the sale of that partnership item, okay? So again, why is this revenue ruling here? It's for the simple proposition that the partnership will dictate the character of the income, not the capacity of the individual partners, all right? On page 61, there's a court case. My pronunciation is probably awful. I apologize for those who know how this is actually pronounced. But putting aside the pronunciation, this case stands for a simple proposition. And by the way, where was this building located? Good old Newark, New Jersey, right? And there is a condemnation. And under Code Section 1033, if there is a condemnation of property and the proceeds are reinvested, okay, within 180 days, then it can be rolled over tax-free, right? Code Section 1001, which would normally dictate that it would give rise to a gain or loss. Code Section 1033, akin to many of you are familiar with the 1031 exchange. 1033 likewise grants taxpayers tax-free treatment, right? But what was the flaw? Why did the taxpayer come up short in this case, do you recall? Say again, Minna? Be careful of the pronoun they. Who are you referring to as they? Right? Who owned the property before the condemnation? The partnership. The property was owned in the name of the partnership. Well, it's treated as a partnership. And when the property or the proceeds were reinvested, in whose name was the property, the proceeds invested in? And they're in the partner's individual names, right? That doesn't qualify. To have a 1033 exchange, it must be in the name of the original owner. That was not the case here. That being the case, they did not have the shield of Code Section 1033, and the taxpayers got whacked as a taxable gain, right? So this is a lesson here. I periodically get this question from taxpayers. They want to know if they can take the proceeds of a partnership property, and one partner has one idea of what they want to do, another one has another idea, and that doesn't cut it. Okay? If you want to have 1031 exchanges or 1033 exchanges, the starting party must be the same, or the ending party must be the same as the starting party. Okay? Listen, you know under code you can only amend depending on when you pay up to 3 years. So I'm assuming the statute of limitations long past. All right?
Would it matter that they resolved the partnership anyway?
I think it just means they shot themselves in the face.
So I'm saying, even if they had that 3 year, it's not time to amend, wouldn't the part that they resolved it, amended anyway, it was resolved, technically they probably last time.
Yeah, I mean, one thing they could have done, but is they could have reinvested in new property and then liquidated the partnership, and one person could have had tax-free, one wouldn't. I mean, this is just poor planning. I think there could have been a better, much better result. Well, remember, when you get a generic letter from the IRS, that's just a generic letter. You can't rely on that as truth with a capital T. All right, page 64. We have, again, pronunciation not my strength. Added to the list. Schneer. Schneer. All right, stop cursing at me. All right, so for those, most of you have had income tax before, and most of you are familiar with the famous Lucas v. Earl case, right? And what metaphor?
The apple in the tree.
Apple in the tree, right? Okay, right? And then you can't, say again? No, that's a good thing. That's a good thing. You're going to impress your clients, your co-workers, your peers, your friends, your significant other. Lucas v. Earl, right? The apple in the tree metaphor. And then you can't assign the fruit to a different tree than upon which it grew, right? And, you know, simple propositions of if the person earns the funds, he or she should be taxed on it, right? Guys, there's no secret formula. That's the assignment of income doctrine, right? That if you earn the money, you should be taxed on it, right? And here we have a lawyer who works for one law firm who's abandoning ship to work for, apparently, and I don't know how this works, 2 law firms, right? So a glutton for punishment, right? And apparently, he's going to do work for his prior law firm and assign the income from that prior law firm to the 2 new law firms, right? And the question is, should he be taxed? Let's just make up some numbers. The numbers are irrelevant here. Let's suppose the wealth that he generates is $100,000, right? And he assigns that to the new partnership. And the new partnership divides that 3 ways. So instead of him being taxed on $100,000, he's only taxed on 1/3. But it doesn't mean the other 2/3 are going untaxed. It also doesn't mean, unlike some of the the assignment of income cases, it's generally where people are trying to assign to a taxpayer in a lower income tax bracket, right? So there is no, it doesn't have the aroma, right, of where you would typically invoke a tax doctrine, right? So what happens here? Who prevails? If you recall, was the taxpayer or the IRS, guys? The IRS? You gotta reread this case. Right? Because here, the taxpayer prevailed. All right? Unless I'm missing something, the taxpayer prevailed because the taxpayer was, or I should say, the partnership ended up being taxable on this income. When I say the partnership, the partners, not the individual partner. Because what happens when it comes to partnership formation? Should 721 prevail, or should the assignment of income doctrine prevail? And most of you know in the corporate realm, when there's a conflict, what have courts done in the past, at least in the corporate realm? Again, generally, the congressional policy is to make corporate formations as easy as possible, right? So, in general, the assignment of income doctrine goes by the wayside. And similarly, in this case, the upshot of this case is the court said, you know what, when it comes to the assignment of income doctrine, it's not that important here, okay? In most partnerships, let's keep in mind, if you work for a 3-person partnership, and one person works really hard, bills 80 hours, and the other 2 partners bill 40 hours, but they still split the profits in 3 equal shares. And you might say, that's a violation of the assignment of income doctrine, right, guys? But when it comes to a partnership, if that was their economic agreement to share it 3 ways, doesn't the assignment of income doctrine get pushed to the side? And the only thing the court here said is, if this partner, apparently this partner performed work and was owed about $1,250, some small de minimis amount that he was actually owed. Everything else, he had to perform services before it could be assigned to the new partnership agreement. There was some small dollar amount that he was owed no matter what. That he should be taxed on, right? You can't, income that is due and owing to you, you can't assign to some third party. But anything else that he assigned prior to his consulting services, this case, in my mind, stands for the proposition that the assignment of income doctrine is going to take a back seat. All right? So, you tell me, does that work for you? I mean, it's a long case. There's a dissenting opinion. Our authors talk about the controversy, but let's keep in mind, and it was raised by our authors, that the assignment of income doctrine, and all these judicial doctrines, are typically invoked only if there's some sort of perceived abuse. And there's nothing in this case that suggests that the taxpayer was doing this to, remember, his partners are not related parties. He's not trying to necessarily help anyone out here. He's just entering into an economic arrangement, right? And this was his economic arrangement. So, notwithstanding the length of this opinion and the dissenting opinion and the controversies that followed this opinion, personally, I've never seen an issue like this come up in practice. I've been doing this a while, so yes, it makes for some interesting reading, but you will get a lot of what kind of business shall I form? You will get a lot of what are the tax consequences of formation? You will get those questions, I promise you. You will not get the question, well, can I assign my income to the partnership? That's not going to be a top of the line kind of question, okay? Any questions though about this case, guys?
Divided the income, whatever you earn versus whatever you earn.
Anything that was already earned before he joined the partnership, he will be tagged for tax on. But if anything he had to touch or lift his finger and it wasn't yet truly earned, and he assigned it to the new partnership enterprises, that's going to be fine, and it will be respected. All right, so that is not controversial. Everyone's good with that. Makes me happy. That's great. All right, so taxable year of a partnership, right? I would assume everyone in this room, you're calendar year taxpayers, right? That does not have to be the case necessarily with a partnership. Okay? These rules are spelled out in Code Section 706B. Okay? Code Section 706B talks about the taxable year of a partnership. And 706B1B gives 3 different sets of rules. Okay? First, one little I, the majority interest rule, which is defined in B4. That if the majority interest rule, if you have an aggregate interest in profits and capital of more than 50%, that's going to dictate the taxable year. We'll see what that means in a moment. So that's the first rule. That's the big enchilada. You turn the page 76. All this dovetails with what's in your book and what's in the code. If you look at 2 little I, says if there's no taxable year described in clause 1 little I, the taxable year of all the principal partners of the partnership. What's a principal partner? Okay, both of you said it. Where is that defined? Where is the definition of principal partner, guys? 706B3, right? For purposes of this subsection, the principal partner is a partner having an interest of 5% or more in partnership profits or capital. And 3 little I, if there's no taxable year described in clause 1 little I or 2 little I, the calendar year, unless the secretary by regulations prescribes another period. And the secretary has, for your notes, 3 little I, put LAD. 3 little I, LAD. What does LAD stand for?
Vibha's last name.
Whose last name?
Vibha's last name.
Okay, aside from Viva's last name. LAD. LAD. Did I say that? LAD. Lease aggregate deferral. Okay? The regulations, and we'll take a look in a moment at this. So that's rule number 3. On page 76, the first full paragraph gives you rule number 4. Rule number 4 says that if you have a business purpose, you can have a different year. Okay? If you have a legitimate business purpose for doing a different year, you can use it. And this has 2 different tests. under the business purpose. There's a 25% test, okay, 25% test if the gross receipts for a selected year are earned in the last 2 months, or 25% or more of the partnership's gross receipts for the selected year are earned in the last 2 months, or the last paragraph on page 76, a fact and circumstance test. So that's number 4. And number 5 choice is there is an election you can make under code section 444. This is spelled out on page 77. So the 5th option is an election that you can elect a tax year which differs from whatever the year is under the code by 3 months. But there is a toll charge that you have to pay, and the authors skipped the description under code section 7519. Under code section, if you make an election under code section 444, under code section 7519, okay, you have to pay in a sum of money because the tax deferral some of the partners might be able to achieve. All right, now, so we have these different rules, guys. I'm saying there's 5 different rules. 3 under the code, a natural business year, and then an election, right? Just for your information, let's just take a quick look because people will write in their notes, least aggregate deferral, but they may not spell out what that means. So at least on my book, I'm using the 2019 version. On page 1395, there is a regulation under 706-1, 706-1, okay? A3, 4 little I, example 1. I'll repeat. 706-1, excuse me, I didn't realize it. 706-1 is under B, let me just make sure, B3, 4 little i's. I'll repeat, 706-1, B3, 4 little i's. Everyone have this example 1 in your regulations? Because least aggregate deferral can come up in practice. And if you look at example 1, everyone have it? If not, ask your neighbor. You should be able to find it. Got it? Do you have your code? Yeah, but you're not. Okay, but you're not opening in the regulations, so it's not going to help. 706-1B3. Right? Peter, just help him find it for a second. But he's using it in 2020, so he's not going to. You got it? All right. Just make sure, guys, certainly for exam purposes, you're going to have to find yourself in the regs. All right, so example 1, partnership is on the fiscal year ending June 30th. Partner A reports income on the fiscal year ending June 30th. Partner B reports fiscal year ending July 31st. A and B each have a 50% interest in the partnership profits. For the taxable year beginning July 1st, 1987, the partnership will be required to retain this taxable year since the fiscal year ending June 30th results in the least aggregate deferral. Now you might say, how do you know June 30th is the right date? Well, you have to go through a trial and error. So look, they have the word test, right? 6:30, test. So year end at 6:30, they have partner A, partner B. They have an interest, and how much deferral is there if you end months of deferral for 6:30 year end? There's 1 month of deferral, right? There's only 1 month, and the overall deferral is 0.5. If instead use 7/31 as deferral, as the test date, notice that partner A would get 11 months of deferral, right? 11 months of deferral, and partner B would get no deferral, but still the 5.5 exceeds the 0.5. Everyone see that? So the least aggregate deferral is the number that is the smallest. It's like golf. What is the smaller number? That's the least aggregate deferral. And you can look through at these different examples, guys. I don't have to do this for you, but I'm just pointing out you got to do it through trial and error. All right? All right, so let's see how good we are. Let's look at the problems then, beginning on page 78. What taxable year must the partnership adopt under 706B in each of the following alternatives? Unless stated to the contrary, assumed partnership is a newly formed partnership. All partners are calendar year partners. If they're all calendar year partners, what year must they adopt, guys? Calendar year, right? Calendar year. Why? Because that's the majority interest, right? You have 100%. Now, the authors continue and say, if the partners believe that the partnership will have substantial income, are they free to choose what taxable year they select for the partnership? And the answer is no, right? They're not free to select. Now, if they are free to select, what taxable year should they choose? What would give them the maximum deferral? What fiscal year? July, June, anyone else? Any other bidders? How about January 31st? Right? Because picture, if you will, if the partnership starts earning money in February 1st, let's say the partnership earns $1 million February 1st. Well, that February 1st income, 2019 it earns $1 million February 1st. Everyone have the visual? When will that $1 million have to be reported on the, and let's say 2 million, and Min and I are partners. When will Min and I have to report $1 million apiece? We're 50-50. When will I have to report that $1 million?
And your calendar year?
I am calendar year. What year will this end up on a tax return?
2020.
When you say on a 1065 filed in 2020?
Yeah.
No, it will be in let's put it this way, in 2019, when my year ends December 31st, the partnership year has not ended, right? Because it ends on January 31st, 2020, right? So when the partnership year ends in 2020 on January 31st, then for 2020 at the end, December 31st, yes, on my 2020 return, which I file on 2021, right? The 15th day of the third month, right? So do your arithmetic. Something like 26 and a half months after the partnership earns that $2 million, will Min and I have to report $1 million apiece. So
Gives you plenty of time.
gives you plenty of time. Now there's estimated tax payments, but the point is, just notice how much deferral, right? And if the fiscal year were set at January 31st, we could possibly defer a lot of income for many, many months, right? Practically 2 years. So, but the code doesn't permit it. Remember, the authors are just saying this hypothetically. All right, guys? And it says, what if you expect the partnership to have losses? What year do you want? Amen. Calendar year. Question B. Partnership has a 20% corporate GP, which uses a July 31st fiscal year, and 20 individual 4% limited partners, all of whom are calendar year taxpayers.
Calendar.
What's the majority?
Calendar.
Calendar year, right? We have 80% have a calendar year. Once again, we're under the majority rule, right? Everybody agree? These make for good multiple choice questions. Be forewarned. Question C. What results in B above if on the first day of year 4, 10 of the limited partners sell their interest to the corporate general partner? Okay? Okay, if you say July 31st, what's your authority?
Section 706B.
706B says a lot, so what specifically?
706B.
Isn't it 706? B1B, one little I, it's majority interest again. Okay, everybody agree? Still got the same rule here. Well, it's B1, capital letter B, I. Question D. What results in B above if 10 of the limited partners use September 30th fiscal year, the other 10 use a calendar year, okay? Everyone had the visual. Don't say it out loud. No one say it out loud. So in this case, Simone, who gets taxed? What year? You have a year in mind? Not sure? John? You say it loudly? Say 1231. Mike, do you agree? Different mic? Two mics sitting close together. I'm not sure that's a good idea. Second upper tier mic. Say it loudly. What's your authority? Just say it loudly because I'm sure the people on WebEx can't hear you. Two little I, right? We only have one principal partner here, right? Everyone agree? The majority interest rule doesn't control. And we only have one principal partner, which is whom? The corporation. Right? It owns more than 5%. So in this case, question D would be 731. Everyone got that? Question E. What results in B above if the partnership wants to adopt a September 30th fiscal year under 706B1 in order to have sufficient time to gather information for its calendar year partners? And if the partnership adopts the September 30th fiscal year some other manner, if so, with what cost? So can you just adopt a September 30th fiscal year? All right, let's make sure you understand. This would not be a business purpose, right? Everyone agree? This would not be a legitimate business purpose. It would not meet the test number 4, business purpose test, right? So this makes you, under our fifth opportunity. If you want to make an election, right, under code section 444, you have to pay a toll charge, code section 7519. Okay? So if you note, this doesn't cut it unless an election is made. Question F. What result in B above if over the prior 5 years the partnership has been in the retail business and does 20% of its annual business in December and 10% of its business in January and post-Christmas sales? Partnership has been using the calendar year and wishes to change to January 31st fiscal year. May it do so? If so, you have to make the election and you have to make a required payment. Can you just, Sandra? This would, right? You would meet a natural business year, right? So this should work, and you do not, in this case, have to make the election or pay the toll charge. No election necessary, nor is there a toll charge. Right? So these are very mechanical rules, right? There's no cases on this, or either there or you're not there. Purely statutory. Tax consequences to the partners. So here we're introduced to another code section, 705. Determination of a basis of a partner's interest. Alan, is this inside or outside basis? 705. Outside, right? Outside tax basis. Right, Alan? All right. So there's going to be adjustments to the basis, right? There are going to be upward and downward adjustments. Agreed? 705A1 talks about increases. 705A2 talks about decreases, right? And again, let me just say, my experience with many accountants and attorneys, no one has a monopoly on ignorance here, is that many confuse outside basis with capital accounts, right? They start talking about negative tax basis. You can have a negative capital account, right, where you owe money to the partnership. Can you ever have a negative tax basis, guys?
No.
No. All right, but I can't say not a week goes by, but not a year goes by where I don't hear an attorney or an accountant talk about some taxpayer having a negative tax basis. And then you always get into that awkward moment, like, should I tell this person, not tell the person? Do I sound pompous or not? So it's always hard to juggle. Like, what do you do in that circumstance? It's very delicate. And I used to think my role would be to say something, but people have told me, and I think I've learned, that people come to class to learn, but they don't come to practice to learn. So I don't know. I've held back more than I used to, because I don't say, wow, you really got that wrong. I try to do the, like, I think you have, you tried it, but it doesn't matter. People get irritated, like, why are you correcting? I operate on such different principles that people tell me, and I like, oh, you got it wrong, you got it. I'm like, thank you for telling me. I've been doing it wrong all these years. I'm like, but I've seen people be very unhappy campers. All right, so the basic rules, guys. We had these separately stated items. We had these basis adjustments that you have to be sensitive to. These come up routinely in practice, okay? So you have to be aware of them. And they will come up in your exam because now we're operating the partnership, right? We know how 722 and 723 operate, right? But now we have to see when we have a partnership operation, how they're going to operate. And page 82 walks us through an example. So let's see if we can go through page 82, and then we'll take a break. Everyone ready? Page 82. Everyone got their energy? If A and B, both calendar year non-corporate taxpayers, are equal partners in AB partnership, which had the following income expenses during the year that ended July 31st of the current year. Okay? And we're told a whole bunch of items. And we're asked in question A, see there's 4 parts to this question. How and when will AB, that means the partnership, A and B, report the income, and who will be liable for the taxes? And what, just a general proposition, under code section 6031, the partnership tax return is due the 15th day of the 3rd month after the partnership ends. The 15th day of the 3rd month after the partnership ends, which in this case would be, when would the tax return due? October 15th, right? Right? So, and what, just, sorry, gotta repeat myself. This is gonna be under Form 1065, right? And the individual partners are gonna be issued Form K1. And since I'm gonna need your energy and your full attention, 2 things. My understanding is the cafeteria is now open downstairs and they do serve coffee. Not as good as the cold brew, I apologize that I have, but it is open, so if you need some sustenance. And then let me just mention and jot down on your notes, I am 95% sure, unless someone can correct me, that October 26th, that's the day we're supposed to have this alumni event. It is not, I'm going to mispronounce it,
Diwali.
Diwali?
Yeah.
Diwali.
Yeah.
Which is the celebration of lights for Hindus, is great news. It's starting on Sunday. So those who can make it, mark it down. On the 26th, we're going to have this alumni event right here. And for those who've attended in the past, we've had hypnotists, we've had all sorts of interesting mystery dinners, and this is going to be a first. We hired a company to do game night. And you and your significant other, it's going to be a grand night because we're going to have tax and dinner and game night. And we're having a professional company. This is supposed to be like the real McCoy, Family Feud and other games. So mark your calendars. The 26th, you're going to get an e-bite soon. And I would like to see those who can make it. Be great. Your significant others. Be wonderful. So why don't we do this? Again, mark your calendar, October 26th. 1 hour of CE credit. We're going to have some great guest lecturers come.
Who?
We're going to have Professor Falk for those. We're going to have, he's probably going to give me a hard time. So if you want to see me get a hard time, you'll see Professor Falk give me a hard time. Professor, I'm doing a blank. I see him right in front of me. State and local.
Nowinski.
No.
Zemski.
Zemski.
Don Zemski.
Nowinski.
No. The third is, oh no, not state and local. It's tax procedure. Todd Simmons.
Yes.
Okay.
Okay.
Okay, so you gotta come
Okay.
for him. And the third speaker, I'm drawing a former alumni, but he's great, Roddy, who's a great guy, who recently graduated from the program. He's working it with him. So it should be a fun night. I promise you a memorable night. All right, so guys, we have a tough course here. I'm going to be really strict here. Keep it to 10 minutes. I will see you here about 7:40 sharp. Okay? Yes, sir.
May I speak to you?
Absolutely.
Professor, cannot see the board.
Did I cover something?
No, no.